Have you ever stared at a crypto chart, watching that line jump all over the place, and just wondered, what is actually going on here? What gives this stuff any value in the first place? Well, we're going to break it down and build a framework to understand what's really driving these prices.
So let's get right to it. What is really behind those massive, wild swings we see in crypto prices? Is it all just cold, hard computer code? Is it pure hype and human emotion? Or is it a mix of things that we can actually understand and even track? That's the core question we are going to unpack today.
And here's our roadmap for how we're going to do it. We'll start with the absolute basics, the engine that runs all markets. Then we'll dive into the unique code that creates scarcity in crypto, what drives people to actually want to buy it, the powerful role of psychology and hype, and finally, the big forces from the outside world. By the end, we should have the complete picture.
Okay, first up, the fundamental price engine. Before we even get into anything specific about crypto, we have to start with the one timeless principle that pretty much governs every single market on Earth.
It all comes down to this: supply and demand. It's just a constant balancing act, a tug of war, really. If way more people are trying to buy an asset than there are people selling it, the price has no choice but to go up to find a new equilibrium. And of course, the opposite is true. This constant push and pull is the engine that discovers the price of an asset 24/7, all around the world.
So, now let's talk about the supply side of that equation, because this is where crypto gets absolutely fascinating. See, unlike dollars, where a central bank can just decide to print more, in crypto, the rules of supply are often written directly into the code. And this is where the idea of scarcity becomes so incredibly important.
We call the study of this tokenomics, a mix of token and economics. It's basically the economic blueprint for a digital currency. It tells you everything, from how many coins will ever exist, to how new ones are created, to how they're handed out. And seriously, a project without a crystal clear tokenomics model, that's a major red flag.
And you usually see three common models. The most famous is a fixed or capped supply. Bitcoin is the classic example. There will only ever be 21 million coins, period. That scarcity is programmed right in. Then you've got inflationary models, where new tokens are always being created. And on the flip side, you have deflationary mechanisms, where tokens are intentionally destroyed or burned to make the remaining ones just a little bit more scarce. Now, this brings us to two really crucial metrics you'll always hear about. First is market cap. That's just the current price times the number of coins that are actually out in the world right now. It's the network's current value. But then there's fully diluted market cap. This one looks at the network's value if all the coins that could ever possibly exist were already in circulation. The gap between those two numbers is so important because it tells you how much the value could be diluted in the future as new coins are released.
This gold mine analogy is the perfect way to think about it. Imagine a massive new gold mine is discovered tomorrow. Well, the value of all the gold that already exists would probably take a hit, right? It's the same exact principle. A huge flood of new tokens entering the market can water down the value for everyone who's already holding.
And there is no better real-world example of this program's scarcity than the Bitcoin halving. It's an event that's literally baked into Bitcoin's code. About every 4 years, the amount of new Bitcoin being created gets slashed in half, just like that. This creates what's called a supply shock, and it makes new Bitcoin twice as hard to come by almost overnight.
And if you look back at history, the impact has been pretty dramatic. You can see it on this timeline. After the halvings in 2012, 2016, and 2020, the price saw a major bull market in the following year or so. When you slash the flow of new supply, but demand stays the same or even grows, that fundamental supply and demand principle kicks in and the price tends to go up.
Okay, so that's the supply side. It's predictable, it's mathematical, it's all in the code. But what about the other half of the equation? What actually makes people want to buy this stuff in the first place? This is where things get a lot more dynamic. Real, sustainable, long-term demand usually boils down to three big things. First, does it have real-world utility? Is it actually solving a problem better, faster, or cheaper? Second is mass adoption. Are more and more people, businesses, and even big institutions starting to use it? And third is something called the network effect, which is this incredibly powerful feedback loop. And when we talk about mass adoption, just look at this number. We're talking about over 560 million crypto users globally as of 2024. Let that sink in for a second. This is not some small niche hobby anymore. It's a global phenomenon, and every single new user adds to the potential demand.
And that brings us to that powerful idea, the network effect. Think about the very first telephone ever made. It was totally useless, right? There was no one to call. But as more and more people got phones, the value of the entire phone network grew exponentially for everyone. Crypto works the same way. Every new user, every new application makes the entire network more valuable, creating this powerful cycle where growth just fuels more growth.
Okay, so we've got the coded supply and we've got real-world demand. But there's a third, incredibly powerful layer we have to talk about: human psychology. In a speculative market like crypto, emotion can often be the single biggest driver of price, especially in the short term. And the market tends to swing between two emotional extremes. On one side, you have FOMO, the fear of missing out. You see prices just rocketing up and you feel that pressure to buy in, which pushes prices even higher, creating these bubbles. And on the other side, you have FUD, fear, uncertainty, and doubt. A bad rumor or some negative news hits, and it can trigger absolute panic selling, causing prices to crash.
We can even try to measure this emotion with tools like the Crypto Fear and Greed Index. It looks at things like social media chatter and market volatility and gives a score from extreme fear all the way to extreme greed. Now here's the key insight. Many experienced traders use this as a contrarian indicator. You know the old saying, be greedy when others are fearful and fearful when others are greedy? This index tries to quantify that exact moment.
Now for our final layer. See, the crypto market doesn't exist in a bubble. It's constantly being influenced by the wider world, especially by two major outside forces: government regulation and the global economy.
Regulation is a massive factor, and it can be positive, negative, or just clarifying. For example, a positive development like the approval of Bitcoin ETFs can be a hugely bullish signal, boosting confidence and attracting a flood of new capital. But negative news, like a country banning crypto trading, can create fear and trigger huge sell-offs. And then, sometimes you just get clear, sensible rules, which might seem boring, but they're essential for stabilizing the market and fostering long-term growth.
And then, of course, there's the broader economy. High inflation can increase demand for scarce assets like Bitcoin as people look for a potential hedge. Decisions on interest rates by central banks can pull money away from crypto or push it in. And big global events? Well, geopolitical instability can cause investors to either sell crypto as a risk-on asset or run to it as a non-sovereign store of value.
So let's bring it all home. We've looked at the code, the users, the emotions, and the outside world. Now let's put all of those pieces together to get the complete picture of how these crypto prices really work.
So if there's one thing to take away, it's this. There is no single driver. A crypto's price is this dynamic, constantly shifting mix of its predictable coded supply, its tangible real-world utility, the wild collective psychology of the market, and these powerful external forces from regulators and the global economy.
Which leaves us with a final question to think about. When you look at that price chart, what are you really seeing? The elegant logic of code? The growing power of a global community building new things? Or is it just the chaotic, unpredictable emotion of the crowd? The answer, of course, is probably all of the above.